All right, today we're going to dig into a real head-scratcher. Freeport McMoRan just dropped their earnings on January 22nd, and on the surface, things looked pretty great, but the stock went the other way. So what exactly did the market see that maybe the rest of us didn't? Let's get into it. And yeah, that really is the million-dollar question, isn't it? The company beats expectations, so the stock should go up. Simple. Except that's not what happened here at all. It's the kind of thing that makes you wonder, what was really going on under the hood? Let's find out. Okay, so first things first, let's just lay out the raw numbers, the ones that were supposed to paint a really positive picture for everyone. Let's kick it off with the big one, adjusted earnings per share. The company came in at 47 cents a share. I mean, they absolutely crushed the 29 cents analysts were calling for. That is a huge, huge beat, and it's typically the number that Wall Street pays the most attention to. And it wasn't just on the earnings side either. Look at the revenue. It also came in hot at $5.63 billion, clearing the bar pretty easily. So you look at these two numbers and you're thinking, wow, this is a home run. Okay, but here's where we get a little asterisk. If you look at the official GAAP number, that's the one with all the accounting rules, it actually showed a tiny miss. But honestly, the market usually tunes out that noise and just zeroes in on the adjusted number, which, again, was a monster beat. So this probably isn't the reason for the drop. Not the real story here. And yet, there it is. The market's final say on the day was pretty clear. The stock closed down 2.7%. So you've got this great report, and the stock sells off. This is where things really start to get interesting. So to really figure this puzzle out, we have to look past the numbers on the page. It's time to break down what management was trying to tell us, and way more importantly, what investors were actually hearing. So if you listen to the CEO, Kathleen Quirk, on the earnings call, everything sounded fantastic. This quote right here really captures the vibe. Management was spinning a tale of a super bright future, lots of growth and tons of cash rolling in. A really rosy picture. But here's the thing. Wall Street is always looking forward. They weren't trading on last quarter's results, they were trading on what's coming next. And as you can see, investors were lasered in on a few key things. Their copper sales forecast for 2026, the big risks tied to restoring their huge Grasberg mine, their U.S. growth plans, and of course, how much cash they're planning to spend. The future was everything. Now, to really get why the market was so jumpy, you have to know about the Grasberg mine. Look, this isn't just any mine. It is an absolutely massive asset for Freeport over in Indonesia. After a tragic event stopped everything, getting it back up and running is probably the single most important thing for the company's future. Any sign of a delay or a problem there, and investors get really nervous. So here's their game plan for getting Grasberg back online. It's this careful, step-by-step process. And while it all looks great on a slide, if you're an investor, you see all the places where things could go wrong. It's a huge undertaking, and that execution risk, the chance that they stumble along the way, was clearly weighing heavily on people's minds. Okay, so we've got a great quarter, but it's got this cloud of future uncertainty hanging over it. But there is one final, absolutely crucial piece to this puzzle, and it actually has nothing to do with the earnings report itself. It's all about the setup heading into the announcement. And this is really the key to the whole thing. The market for copper is on fire, right? Think about all the EVs, all the AI data centers. Demand is through the roof. And the earnings report, as we saw, was good. So you got to ask yourself, why was the bar set so incredibly high? Why was a good report met with a shrug? And this chart says it all. Just look at that run-up. In the single month before earnings came out, the stock was up 35%. Over 3 months, it was up an incredible 45%. The market had already priced in a blowout quarter. All the good news was already baked into the stock price, and then some. And that brings us to the verdict. The sell-off had nothing to do with a bad quarter. It happened because the stock had just gotten ahead of itself. It had run up so much, so fast, that the market wasn't just expecting a good report, it was expecting perfection. And when that 2026 guidance was just good and not mind-blowingly amazing, investors decided it was time to take some profits off the table. A good quarter simply wasn't great enough. Okay, so that's the rearview mirror. Now let's look down the road. What should we be watching for in the next earnings call? Well, here's our take. For the next quarter, we're thinking adjusted earnings will land pretty much in line with what Wall Street is forecasting. You've got those strong copper prices helping out, but that's going to be offset by the initial costs of getting Grasberg going again. On revenue, we think they could pull off a slight beat, mostly because commodity prices are so high. But let's be real, the only thing that's going to matter is that Grasberg restart. All eyes will be on whether they are on schedule and hitting their targets. So going forward, there are really two competing stories here, right? You've got the bull case and the bear case. The bulls are saying, hey, the world is electrifying, AI is exploding, and that means copper demand is going to be massive for years to come. That's a huge tailwind. But the bears are all pointing at Grasberg, saying any hiccup, any delay is going to crush the stock. Plus, with a valuation this high already, there is just no room for error. They need to execute flawlessly. So where do we land on all of this? We're rating the stock market perform. Look, the long-term story for copper is absolutely fantastic, and Freeport is a best-in-class operator. But right now, we think the stock price fairly balances that huge opportunity against the very real near-term risk of pulling off this massive Grasberg restart. And of course, we have to say, this analysis is for informational purposes only. It is not financial advice.